Federal Open Market Committee reaffirmed the current 0 to 0.25% target range for the federal funds rate. Since the committee met in July, the pace of job gains has been solid. The unemployment rate has declined, and overall labor market conditions have continued to improve. Inflation, however, has continued to run below our longer-run objective, partly reflecting declines in energy and import prices.
Buckle your seatbelt. It's time for another episode of the Prepper Recon Podcast. Whether your plan is to bug out or bug in, CampingSurvival.com has all of your preparedness needs, including fish antibiotics, long-term storage food, and water filters. Use coupon code PrepperRecon for 5% off your order at CampingSurvival.com. Hey Preppers and Patriots, this is the second half of my interview with John Rubino from DollarCollapse.com. Enjoy the show. The Baltic Dry Index is at historic lows. No ships are moving. What does that tell you?
Well, yeah, that's a indicator of the price of renting a big container ship. And when the price goes down, the implication is either they built too many container ships in the last few years, or people aren't shipping as much stuff anymore, so they don't need as many ships. I think we have a combination of those two things happening right now. And the implication is that global trade is shrinking. And that means that the global economy is slowing down. You know, there's a lot less raw materials being shipped to China now that China's wound down its infrastructure binge. And that's not going to change in the near term because China is in the early stages of a credit crisis that it has to get through. And there's a lot, apparently, less trade going on in finished products between Asia and the U.S. and Europe. And so there just aren't that many ships being demanded anymore. And that means the global economy is slowing down. You know, when trade goes up faster than the global economy, that's a good sign, and vice versa. You know, and trade right now is shrinking faster than the world's GDP, which implies that the world's GDP is going to catch up at some point. And we've got a pretty serious drop in general output around the world, which shouldn't be a surprise. We borrowed insane amounts of money over the last 30 or 40 years. And debt works the same way for a country as it does for an individual, which is to say that once you borrow more money than you can ever hope to pay off, your life kind of spins out of control. And you don't get to consume as much as you would have otherwise because you're paying interests, you know, and principal. And that's soaking up all your free cash flow. Same thing with the rest of the world. You know, Europe is insanely indebted. They owe so much money when you consider unfunded liabilities of their government pension plans, which they don't fund. They just run it out of cash each year. And as the baby boomers retire, the cash cost of national pension plans is soaring. Same thing in the U.S. You know, we owe 3 or 4 times as much money as a percent of GDP as we did 30 years ago, when you include unfunded liabilities of Social Security and Medicare. And it's more than we can ever hope to pay off. And so one way or another, we have to live within our means. And we do that by scaling back, which is to an extent happening at the grassroots level. You know, people just aren't buying as much stuff anymore. And also at the state and local level, where those governments aren't able to grow because they're so debilitated by the pension plans they set up in decades past. And so that all their money flows into teachers and firemen pensions. And very little of it flows into construction and hiring new people, et cetera, et cetera. So the global economy is cracking under the weight of all this debt. And again, left to itself, in the absence of some massive intervention by the world's central banks, we would see trade shrink and GDP stop growing and generally the global economy kind of grind to a halt. That's what we would see. And who knows whether this is it or not, but this is how it will feel. You know, the last 6 months or so is exactly how the process of getting into a global slowdown, which leads to some kind of a serious crisis, will feel.
And Walmart's closing 269 stores. They're laying off 1,600 employees. Now, after the last State of the Union address, I thought, oh, well, that's probably because everything's so good people are going to stores like Macy's instead because, let's face it, Walmart can be sort of a painful experience sometimes. But Macy's, they're closing stores as well. They're shutting down 40 locations and laying off 5,000 employees. Do you think this is going to be a trend for 2016, store closures and layoffs?
Oh, yeah. Bricks and mortar stores are an idea whose time has come and gone. Most people shop online, and it's getting easier and easier all the time. We see our UPS guy more than any other non-family member in the country.
That's true.
Yeah. And I think it's the same for a lot of other families. It's just much easier to buy the basic stuff that you need once you know what it is and how much it should cost online. And so the big department store chains are in trouble, and the mall real estate investment trusts that own the places where Macy's and Sears and Kohl's and all the rest do their thing, they're in trouble. So we're going to see a commercial real estate bust that basically gets rid of a lot of this useless space. Now, I don't know what they'll do with it. We're going to have a lot of empty malls sitting around for quite a while, but it's not really needed anymore because people have changed their behavior, and technology has made department stores, for instance, obsolete. So that's another big change. And see, we've got so many changes going on right now that are all pointing in the same direction. There are very few changes that are pointing towards a boom in the future, especially in hiring, because most of the technological changes that we've got going are towards greater and greater efficiencies, which means fewer and fewer people, And so warehouses, factories, malls, all of these things need fewer and fewer people to the extent that they need to exist at all. And so the jobs market is going to be really challenging going forward. At the same time, government finances are kind of overwhelming to the governments. So, yeah, God, it really does look like the kind of perfect storm that you mentioned one of the big banks talking about, where a whole bunch of things happen at once, any one of which would be problematic, but all of which taken together are overwhelming. And that's our immediate future, the next 2 or 3 years.
We're going to take a quick break, and we'll be right back. The dollar's lost over 90% of its purchasing power since 1971. Silver, on the other hand, has proven to be a very stable form of wealth preservation over the years. And where do you buy silver? Silver.com, of course. Silver.com offers fantastic prices on gold and silver. Check out silver.com today.
Get prepared before disaster strikes. PrepperRecon.com offers MOLLE-compatible individual first aid kits for your home, auto, or bug-out bag. These kits have everything you need to address a traumatic injury, including an Israeli battle dressing, quick clot, EMT shears, suture kit, steri-strips, tourniquet, tough strip bandages, and so much more. Kits are available in OD Green, Coyote, Black, and ACU. $99 includes shipping. Go to PrepperRecon.com and click the Store tab at the top of the home page. Order today before it's too late.
Yeah, and you mentioned malls. The mall by my house has something like 30 vacancies in it, and that was at Christmas. And it had a lot of little sort of pop-up stores in it that were just Christmas wrapping and I mean, one place is just nothing but calendars. Two candle stores in there. One of the stores is a convenience store in the mall where you can get Slurpees and lottery tickets and cigarettes and stuff. It's just really insane, the type of things that are in the mall that you used to would have never seen. And it's just like it's completely crashing. And, and then all the empty stores, they've got them dressed up to make it look like there's actually something in there, sort of the Potomkin Village sort of trick, I suppose they're trying there. But now, besides the job losses from Walmart closures, some of the small towns won't even have grocery stores or gas stations once Walmart picks up and leaves. In many of these small towns, Walmart came in. They ran out the mom and pop businesses. So they were basically the only game in town. Could we see that same type of thing happen with imports since the Baltic Dry Index is crashing? Could we see shipping companies go out of business? And since there's no more production in America, could we see America stuck without being able to get those goods and no means of producing them themselves?
Well, in the short run, there'll be disruptions, but in the long run, the production will just come back home if that's the way it works out. And that's another technological trend. It used to be that cheap labor was the key to where you sited a factory. And that's not true anymore. With 3D printing, you can just download a design to a machine which spits out the thing that you're trying to make. And as that gets more and more efficient, then more and more production will come back home. In that kind of a circumstance, proximity to your customer is a much bigger deal than cheap labor costs, right? You want to be face to face with your customer so you can custom design some product which you'll print out and give to them immediately. That's the future of manufacturing. And so in any event, we were going to see a lot of manufacturing activity come back to the U.S., which is a crisis for the developing world. That's their real ace in the hole is cheap labor. And if that's not an advantage anymore, who knows what happens to them. But that doesn't mean a lot of people get hired in the U.S., though, because a desktop printer does not need a lot of people to manage it. And so we could be doing way more manufacturing in the U.S. 20 years from now than we're doing today, but employing zero new people, different people. We'll need techies to run the manufacturing side of things, but we won't need big, strong guys to move things around on the factory floor anymore. And so, that's another issue that we've got to deal with, where it's not clear how we keep everybody working while we go through this transition. So, I don't know. I wish I had a lot of optimistic stuff to throw out to offset some of the pessimistic stuff. But the fact is, we've just screwed up the system, And when you screw something up, you reach a point where there's no real fix for it, and you just have to let it break. And that's the same thing for individuals. When you mess up your life to the point that the things you thought you had, you don't have anymore, and you just have to let them go. That's kind of where the U.S. is and the global financial system is. And there's no way to predict ahead of time how that transition plays out, except that it'll be very messy.
And oil's bounced back some, but it still remains volatile. But at $26 a barrel, it didn't really sound good for the petrodollar. Where do you think we're headed from here with oil? And is there any plan B for backing up the dollar once the petrodollar system fails?
Well, we're still producing globally too much oil, and a lot of it is just being shipped into storage. So as the storage space starts to run out, you get the potential for a really serious kind of air pocket break in the price, where it drops to some level that takes enough production off the market to bring things back into balance. And it doesn't seem like we're there yet, so we might have another tough year in the oil market. And that's a problem for the petrodollar. Right now, that's being masked by all the capital inflows into the U.S. I don't think Russian millionaires or Brazilian business people care whether oil is priced in dollars or not. They don't care about the whole petrodollar concept. They just want to get their money into a safe place. And that's a huge prop under the dollar right now. And if the Fed is the only central bank that isn't cutting interest rates actively or flooding the system with newly created cash for a while, then that means other things being equal, the dollar will go up from there. So we could see another really strong dollar year. But again, that's just kind of the last gasp of the old system. It doesn't mean the dollar is actually a strong currency. It just means it's strong relative to these really crappy currencies out there. And that relative to real stuff, to the actual world, the dollar is also not a good store of value. And so at some point, the numbers are going to tell the tale. We're going to see the U.S. dollar behave as it should based on the imbalances that have built up. And then it'll go down in value, not necessarily against the ruble or whatever currencies the Europeans use after they get rid of the euro, but it will go down versus real stuff. So we'll have inflation here in the U.S. as well as in the rest of the world, and the dollar will gradually become less and less viable as a store of value. You just won't want to hold it if you're not going to use it right away. So you'll take your paycheck and you'll turn it into real stuff immediately. And that's in Austrian economics, they call that the crack-up boom, when people lose faith in a currency and they just swap it for real stuff as soon as they get it. And so prices spike, but it's not because of the supply of dollars spiking. It's because of the faith in the dollar eroding. And that's out there too. That might be a later stage of this process, but it's definitely coming.
And we mentioned that the Fed decided to not move today. What do you think they're going to do going forward in 2016? Do you think they're going to try to raise rates, or do you think they're going to have to claw back the 0.25% we got from 2015? What are they going to have to do?
Well, I think they boxed themselves into tightening for a while. And the reason they want to raise rates is so they'll have some ammunition in the next crisis. If you're already at zero, and cutting interest rates used to be the way that you deal with a financial downturn, what do? If you're at zero, you have to go to negative interest rates, which brings a whole bunch of new problems along with it. They don't want to do that. They'd rather have a 5% Fed funds rate that they can then cut to 2% to stop the next crisis. Well, they waited too long. It's too late for that now because the crisis is already starting. And so I think they will try, as they did today, to not intervene and not start a new round of tightening. And at some point, the crisis will get severe enough that they have to reverse course. And so out there somewhere is an announcement where the Fed comes out and says, you know what, we're data dependent and the data have changed. So we're going to go along with the tide of the numbers. And we are going to cut interest rates dramatically, and we're going to increase quantitative easing to some unprecedentedly high number and blah, blah, blah. It's going to happen. And something like that will happen at some point. And the question is when. How bad does the crisis have to become before the Fed panics and decides to go back to the old way of doing things? Of course, there's no guarantee that works. The fact that it didn't work over the past 3 or 4 years, we're heading into another financial crisis after the whole world has flooded the system with new currency, and banks have massive amounts of reserves, and interest rates are at unprecedentedly low levels. After in that environment, we're still tipping over into recession. So it's possible that people see the Fed doing the same thing again and say, well, if it didn't work last time, why will it work this time? And responding in the opposite way from what the Fed hopes. So that's a possibility too. There's just no way to know.
And how do we hide from this? Is this going to be an inflationary collapse? Is this going to be a deflationary collapse? Where can we go? Where can we put our assets?
Well, this is uncharted territory, so we can't know what's going to happen exactly, except that it'll be chaotic. So you hide from chaos traditionally in precious metals. It's the kind of money that governments can't make more of. Therefore, it tends to hold its value when they're making way too much of the other currencies. So that's a place you can hide out. Really, really well-chosen real estate has traditionally also done okay. In other words, not a San Francisco townhouse for $7 million, but someplace, a nice rental property near the edge of a college town in the Midwest or something like that, where there's pretty steady demand and the price isn't outrageous, and you can count on cash flow from that, or at least a stable value in the future. Things like that will do okay too. I know that takes an awful lot of expertise and work, but that's where we are. We're at a point where you can't just toss money at a brokerage house account and buy random mutual funds and make lots of money. Oh, and of course the other thing that you can do in this kind of a circumstance is to short. In other words, bet against the financial markets. Any of your listeners who haven't seen the movie The Big Short yet, go see it. It's actually funny. It's a comedy in a lot of ways. At least I was laughing out loud at it. My wife didn't find it funny. She thought it was terrifying. But either way, really interesting, really compelling. And it's about how some guys back in 2006 and 2007 made a fortune from that financial crisis. So it's a good lesson in what will make tons of money going forward if you have some expertise and some guts. It's not easy to bet against stocks because we're so programmed to just bet on things that we think are going to go up. Betting on something you think is going to go down is disturbing for a lot of people and stressful. But that's where the money is made at the peaks of markets. When things are going to turn down and really going to crash, you can make a fortune by shorting. So it's also something for people with a proclivity for that kind of thing to look into now and get educated about in anticipation of a couple of really good chances somewhere in the next few years.
And if you're going to try shorting, for the novice, do you recommend that they try to do that through an ETF so that if their timing's a little bit off, they don't lose everything? And because of an option, if it expires in 30, 60, or 90 days, and you're early, then you pretty much lose everything. But you have sort of the time loss if you have an ETF, but you could be as much as you could be a year early and it could still pay off, right?
Yeah, don't mess with leverage. That's one thing you don't want to try, especially when you're fairly new to stuff like this. And I'm talking about options, as you said, which expire after a certain point, so you have to be right on the timing as well as the event. Don't do that. Also, stay away from those leveraged ETFs because they erode a little bit. They don't actually own the stuff that you're shorting. They use futures contracts which erode in value a little bit at a time. So you can just be sitting in one of these leveraged short ETFs, and even if you're kind of sort of right, you still lose. So you want to be a lot more conservative. There are actual actively managed mutual funds like the Prudent Bear Fund and several others that employ people to figure out how to short the market. And you can invest with them, and that'll probably do well in a bear market. And then there are ETFs, which are exchange-traded funds that you can buy like a stock that aren't leveraged, but that are still negatively biased. And you can look into some of those where, if you're right, you won't make huge multiples of what you would have made by just shorting the stock market yourself, but you'll still make pretty good money. You'll make money rather than lose money in something like that. So I would advise, if you're going to bet against the market, do it in a fairly conservative way to avoid the risks that come with shorting if you're wrong on the timing or the specific event or the specific instrument. Diversify and be conservative, but you can still be biased towards betting against the stock market and the financial market in general, and you can still make money.
John, thanks so much for being with us today. Can you tell everybody one more time what day of the week your new show comes out and where they can find it?
Yeah, you can find it on dollarclaps.com. There's a links list for past podcasts buried in the big links list of breaking news. And also it comes out Monday or Tuesday of each week. Depends on how well I do on Monday, if it comes out that day. And if not, it comes out on Tuesday. And let's see. Dollarclaps.com is the website to check out. And my most recent book is The Money Bubble, What to Do Before It Pops, which was 2 years early, but is now really starting to work out. So it's something that, even though it's 2 years old, is very, very timely.
And folks could get that right now and read it and probably still get in and get some protection before everything completely falls apart. Because one thing about these markets is they do tend to sort of do this slow motion train wreck until it's a fast motion train wreck. Yeah,
like the old Ernest Hemingway quote about how a guy went bankrupt slowly at first and then all at once. And that's the way we're doing it.
Yep.
In the U.S.
John, thanks again.
Sure thing, Mike. Good talking to you.
Are we living in a time of which there is more prophetic writings than of any period in history? Watch through the eyes of Noah Parker and his family as a global empire takes shape. Ancient writings are fulfilled, and the last days fall upon the once great United States of America. The Days of Noah, Book 1, Conspiracy by Mark Goodwin, is a fast-paced fiction thriller which looks at how modern conspiracies could play into biblical prophecy concerning end times. Buy The Days of Noah in paperback, Kindle, or audio edition at Amazon.com today.